Indian markets pretty much had been rallying, but the big pivot for the global markets came last week when Fed chair said that the rate cuts are now coming into view. But since then, there have been 3 Fed members that have pretty much downplayed that rate cut talk, saying that they are not even a topic of discussion right now. So I have 2 questions over here. First, what do we believe? What they were saying on Wednesday or what they are saying now? And second, is that the market running ahead of this entire, the talk of a rate cut?
Yeah, you've put some very good points there, because if you simply go back to the narrative of the last few meetings, it was that this is too early to really discuss this, and they didn't want to really get into rate cuts till they were sure that their targets were being achieved. Now, what they have done here is simply use language as a policy tool, which is also something they were doing more than a year back when they were hiking rates, and they slowed it down from 75 bips to 25 bips. And then were not hiking, but were still using language by saying that we need to keep rates higher. And that essentially got the bond market continuing to fall and, pushing up interest rates in terms of bond yields. So often, policymakers will use language rather than actual actions to do something, which is sort of what I think has happened here, where Powell has, used his space to explore that and push markets in a particular direction in terms of specifically the bond market. You see, the bond market had fallen so much that the cost of borrowing, and remember that there's a huge borrowing program for the US government ahead, they can't just let it spiral out of control. So they probably needed the bond market to cool off a bit more, and that is what they have done with the use of language. But there's been no particular action in that. That is why doubts will remain on the table as to how soon this can happen. Can inflation really, go back to zero or sub 2%? Will it rebound? Because there are a lot of research out there that says you'll probably not go below 2% and you'll probably stabilize near 3% for the rest of the year. That will make it difficult to cut rates beyond a point. So those are issues we will deal with, which is why I think the macro risks to markets are not gone. But in the short term, it definitely created the momentum for things to continue in a particular direction. We'll have to be watchful starting January of 2024, which is also a seasonal period where many times the markets historically have peaked, and so we should be aware of that, keeping the entire perspective in mind that the current momentum can get pushed back, because we've had a pretty good rally. I mean, from 18,800 we are at almost 21,500 on the upside, which is pretty big, and may have discounted a lot of what has happened this month, from elections to the Federal Reserve decision.
And sir, talking about discounting a lot of these good news, another thing I think the market is discounting is that, US is heading towards a soft landing, because the Fed chair, Mr. Powell, also said that, risk at this point are well balanced. If the economy shows signs of slowing down, they'll be ready with rate cuts. So are we in fact heading towards that soft landing sort of a scenario, or recession? Is recession still on the cards?
I would like to keep it open, because there are a lot of mixed data points. I try to track a lot of different things from different researchers specific to the US market, and it's not clear whether it will be soft landing or it will be a recession. And how do we really define a soft landing? Would mean that you have a slowdown in multiple sectors, which has sort of already happened. I mean, the only place you have excess is places like consumption. Your manufacturing PMIs are already sub 50 for quite a while. Same with services. So you're actually seeing negativity in meaningful parts of the economy, but not everywhere. And that is so it's already a slowdown in that sense. But then if you go by headline GDP at 4%, you'd say, where's the slowdown? So that growth is also happening in particular sectors. So it's pretty much fractured in that sense. Will it become broad-based is what we will end up calling it as a recession, where growth really flattens out across the board. In fact, even GDP numbers for this quarter may not be at 4. It will probably drop back to a 1, and eventually average out for the full year at a 2, 2.5 or something like that.
Good morning, Rohit. There is bond yields are cooling off. Dollar is easing. There are rate cuts on the horizon. And FIIs coming to India are back with a bang. In December alone, as you know, they have bought almost 30,000 crores worth of equities in India. Do you expect these inflows to continue, and which are the sectors you're looking at will benefit most from this reversal of FIIs coming to India?
So again, I would not want to jump to a conclusion on what FIs end up doing. Surely they've been selling large caps. So the easy answer is if the money comes back, you get a good large cap rally, and specifically in banking. So that would be the easy answer if the money flow continues. I hope it is not just year-end asset allocation happening, because what happens also at this point of time, a lot of funds do allocate money in places where they need to show performance, where they may have missed out, and that leads to a lot of money flow into equities globally. We want to see whether this trend continues and it's not just temporary, because there have been many phases where you've seen FII flows into India come in and then peter out again. So I hope this is not one more of those episodes, because on a 3-year basis, this is the 3rd year where on a net annual basis, we are still seeing outflows. But we did have good inflows, sometime in May, I think, if I'm not wrong, April, May, once the rally had kicked in, and then again it cooled off and it went negative into August, September, and so on. So we want to see whether December continues into January. I think that will be critical in terms of understanding whether these flows are more permanent and not just temporary.
Mr. Srivastava, and what's the mindset of the investors that you're talking to? Are they looking at this rally as a way to build long-term portfolios for the next 5 to 10 years, or are they using it as an exit point to book profits?
So there are different groups of investors. What you're talking of is active management and passive management. I've had to spend a lot of time explaining it to people who read my work on an everyday basis, because we have gone from passive to active in the last 6 months. So I actually take that kind of a switch in terms of my mental communication. That earlier it was okay, markets are good, you're in a bull market, it'll keep on going, we're projecting 20,000, 21,000 and 25,000 and maybe 35,000, and you just stay invested for the long haul. The risk of this entire thing from the US, when bond yields were rising and the potential for a recession, which we are talking about, if I could say that certainly it's off the table, then I would do what you're saying is remain passive, just stay invested, look for dips to buy for the long term. Now that doesn't change completely, but I do feel that there are some serious risks that can show up in 24 in the new year. And for that reason, creating some level of cash at these levels is also important, because we cannot say that valuations are cheap in any case. On our platform Strike, if I just open the valuation charts of multiple stocks, whether it's a large cap like Reliance or whether it's a mid cap or small cap stock, they are all in the more than one, closer to 2 standard deviations of their historical valuation range over the last 10 years. So when you're and I'm saying positive 2 standard deviation. So when most valuation parameters in the positive 2 standard deviations range, that you're buying at the top end of long-term valuations. And so the bet has to be that growth will continue to be stupendous going forward. That's the only logic that would apply to keep investing at these valuations. Otherwise, it would be an extremely overvalued market. So given that, creating cash for volatility along the way makes sense. I will not put a number on what percentage cash, but I think the rally is worth booking some gains and creating cash for future entries that you can make at lower prices.
Rohit, of all the good news, adding to a risk, there is one hiccup that has happened because of the Houthi militants in Yemen. Now, British Petroleum has become the first oil company to haul all shipments through the Suez Canal. As we know, for the viewers, almost 50% of world shipping transits from Asia to the Mediterranean through the Suez Canal. Now, my question to you is, do you see this having a long-lasting impact on oil prices, or and do you see in the long run oil companies will be factoring in militancy in their costs?
We have seen an initial reaction. The oil prices have jumped by 2% or so.
2%, yeah. But is it going to last a long time?
Yeah, see, geopolitical risks are the toughest one. I can upfront say I'm not a geopolitical expert, but the news in particular is not good. Uh, People have been waiting for a while to, get a hold on whether the situation really gets worse, along the canal. If any of the other nations step in and make it difficult for oil, then oil prices definitely shoot up because they had been cooling off in the wake of weaker demand. So demand to supply equations were keeping oil prices down, but geopolitical risks can actually bring them right back up. So even if I think longer term, we don't really see oil prices going much below, 65 to $70 would be the bottom end of the range for oil prices. So we pretty much came close to that level. So there was anyway less downside risk. So any news that comes in from here on the positive side is going to push oil prices higher only. And we'll have to
Right.
factor that in. The only thing is, do oil prices rise slowly or do they rise very, very sharply? Because when they rise sharply, then yes, it's a definite impact on the financials of various net importers of oil and inflation. When they rise slowly, then we sort of tend to absorb that risk into the markets.